Wall Street is spending billions on AI, and if we're being completely honest, they're actually on track to spend trillions. Here's exactly why investors are paying such close attention. Welcome to The Explainer. I'm so glad you're joining us today because we are looking at, literally, the single largest corporate capital expenditure cycle in recorded history. We're talking about an infrastructure build-out that is completely reshaping global markets, supply chains, and the very electrical grid that powers our world.
So let's just dive right in and ask the central question that is absolutely dominating every investor's mind right now. With the sheer velocity of capital flooding into artificial intelligence, are we laying the fundamental groundwork for the next 20 years of human productivity? Or are we just inflating a tech bubble that's going to make the late 90s look like a minor blip? Well, to answer that, we've got to look at the raw numbers.
$650 billion, or up to $700 billion by some estimates. That staggering number represents the projected 2026 big tech capital expenditure. It's an unprecedented 77% surge from just a year prior. Just let that sink in for a second. We're talking about tech giants deploying an amount of capital in a single year that literally exceeds the gross domestic product of entire countries. And this record-breaking spending is deeply dividing the hyperscalers as they race for absolute dominance. Amazon alone is dedicating roughly $200 billion to this build-out, followed really closely by Google and Microsoft. But here's the absolute key takeaway. About 65 to 70% of this money isn't just going into traditional cloud storage. No, it's going directly into specialized AI infrastructure. We're talking brand new data centers, highly specialized GPU clusters, and massive high-bandwidth networking.
Section 1. Echoes of the dot-com era. Is history repeating itself? To truly understand the risks of today's market, we have to look back. Anytime you see this much money moving this incredibly fast, the ghost of the infamous late 90s dot-com crash is inevitably going to enter the chat. And yeah, we absolutely see bubble-like excitement today, but the underlying foundations, they're drastically different. Back in the dot-com era, 85% of tech IPOs were entirely unprofitable. The NASDAQ 100 was trading at an astronomical 60 times forward earnings, meaning investors were paying $60 today for every $1 of expected future profit. Today, the S&P 500 is trading around 23 times forward earnings. Now that's certainly stretched. It's actually the highest since the dot-com era. But the modern AI giants driving this massive rally boast huge, highly verifiable profitability.
Just look at this tale of two hardware kings. Back in 2000, Cisco was the absolute poster child for internet infrastructure. They peaked at around a $370 billion market cap, but with relatively low margins. Now, fast forward to NVIDIA in early 2026, a mind-boggling $4.3 trillion market cap, but it's backed by nearly $216 billion in actual revenue and eye-watering 71% gross margins. You see, Cisco's valuation was largely built on a narrative, right? But NVIDIA's is built on a mountain of cold hard cash and a literal $1 trillion in committed orders through 2027.
But hey, market fragility is a very real thing. Don't let those massive revenues fool you into thinking this is an entirely safe bet for your portfolio. Case in point, January 2025. The market experienced what we call the DeepSeek shock. A Chinese startup released a highly capable AI model that was reportedly trained for a mere $5.6 million. Think about that disparity for a second. The market absolutely panicked, suddenly realizing that throwing endless billions of dollars at GPUs might not be the only way to win this race. And that realization, it wiped out nearly $589 billion of NVIDIA's market cap in a single trading day. A $5.6 million investment triggered the largest single-day loss in market history. Wild, right? This extreme volatility and these record-shattering valuations are exactly why industry insiders are publicly warning of speculative heat. I mean, when OpenAI raised $110 billion at a pre-money valuation of $730 billion, despite projecting literally zero profits until 2030, eyebrows were definitely raised. Databricks CEO Ali Ghodsi flat out called this the peak AI bubble, even while he was raising his own massive rounds. It's just a surreal market right now where companies are being valued at hundreds of millions of dollars per employee.
Section 2. The hardware heavyweights. The Silicon War.
Underneath all this software hype is a brutal, super high-stakes war for the physical silicon that's absorbing all these billions. Now, while NVIDIA utterly dominates the $200 billion AI accelerator market today, with roughly an 80% share, there's a really important trend unfolding that savvy investors are tracking closely. AMD holds about 6%, But it's that 14% slice for custom silicon that's the real competitive threat. Hyperscalers like Google and Amazon are actively out there designing their own chips, purely to reduce their incredibly expensive dependence on NVIDIA.
And the market is rapidly maturing and totally shifting its spending focus. Up until now, the obsession has been entirely on training, using massive, power-hungry GPU clusters to teach AI models from scratch. But the industry is swiftly transitioning to inference. That means actually running those trained models in the real world to generate responses for users. In fact, inference is currently on track to represent 2/3 of all AI spending moving forward.
So the absolutely crucial point here is that inference changes the infrastructure equation completely. It is all about efficiency and the cost to generate a single token, essentially the fraction of a cent it costs to produce every single word or pixel that the AI outputs. And because of this shift, hyperscalers are increasingly pivoting away from standard, super expensive GPUs. Instead, they're moving toward custom silicon and Ethernet fabrics. Companies like Broadcom are stepping up, partnering with AI startups to build rack-scale inference platforms where data movement and networking efficiency are honestly just as vital as raw compute power.
Section 3, AI's massive power problem, the grid bottleneck.
But here's the catch. Even with the absolute most efficient custom chips in the world, this massive financial boom faces a very real, very physical bottleneck that could ultimately dictate the winners and losers on Wall Street. Data center construction is quite literally hitting a brick wall, and that wall is electricity. AI models are just incredibly power hungry. A single AI training cluster can consume as much power as a small city. We're staring down the barrel of a 10x growth in power demand by 2030. In major tech hubs like Northern Virginia, developers are now facing 7-year wait times just to connect to the grid. Plus, local communities are pushing back really hard against the massive strain on their water supplies and spikes in their local electricity costs.
And this energy bottleneck, it's forcing tech giants to hunt for some pretty radical alternative solutions. We're seeing totally unprecedented moves. Amazon and Meta are signing 20-year nuclear power purchase agreements with companies like Vistra just to secure clean, always-on baseload energy. Why? Because these data centers absolutely cannot afford to stop running when the sun goes down or the wind dies off. Other companies are looking to go completely off-grid, partnering up with data center operators in places like Norway or rural North Dakota, where cheap, stranded power already exists.
Section 4, the ultimate payback test. When will AI actually pay off? So all of this custom silicon, the nuclear power deals, and just the mind-boggling infrastructure spending leads us to the ultimate question for Wall Street. When does this actually pay off? Well, brace yourself. Because despite the tens of billions in enterprise generative AI investment, recent MIT data reveals a rather awkward reality. 95% of organizations are getting zero return on their Gen AI investments right now. Literally zero. I mean, sure, we're seeing massive productivity gains in coding and some highly specific niches, but broad enterprise monetization, it is severely lagging behind the massive infrastructure spent.
Because of this glaring disconnect, market analysts have mapped out a pretty high-stakes timeline. We're right in the middle of this massive CapEx boom right now in 2025. But because enterprise revenues simply haven't caught up yet, experts are warning that 2026 through 2028 represents a seriously high-risk window for a market correction. And this is exactly why Wall Street investors are sweating. The underlying math of these trillion-dollar valuations only works if AI revenues begin scaling dramatically by 2030.
So I want to leave you with this incredibly provocative gap identified by Bain & Company. By 2030, the global compute needs for AI are going to cost roughly $2 trillion a year to run. But projected industry revenues are only expected to hit $1.2 trillion. That leaves a massive, glaring $800 billion gap. So as you watch this historic tech build-out unfold over the next few years, you've got to ask yourself, who is going to pay the difference? Thanks so much for watching The Explainer, and stay curious.